Welcome back to the deep dive. Today we're strapping in for a pretty high velocity look at Larsen Toubro Ltd, focusing on their recent Q2 and first half results for fiscal 26.
That's right. And not just the numbers, but also this burst of big strategic moves they announced around late October 2025.
Exactly. So our mission here is to try and make sense of this kind of dual focus we're seeing. On one hand, you've got massive growth, huge international orders driving things.
Yeah, incredible execution muscle on display.
But on the other hand, there's this very deliberate pivot, isn't there, into high-tech areas like defense, clean energy, and also, importantly, getting rid of some big assets.
It really sets up the key tension, I think. How does a giant like L&T manage this historic level of growth? I mean, Q2 order inflows jumped 45%. The total order book is enormous, 6.67 trillion.
Wow.
But at the same time, they're facing margin pressures in some core areas and making these calculated pretty big exits from things like development projects.
It feels like a story of balancing huge ambition with some, let's say, necessary pain. Global scale meets tough domestic choices.
That's a good way to put it. What's really fascinating is seeing them grow so fast, mainly fueled by international demand, while simultaneously taking these, well, substantial impairment charges on older assets.
Like the Hyderabad Metro we'll get into.
Exactly. It signals a very clear strategic shift, prioritizing that profitable, tech-heavy growth over some of the legacy risks they carried domestically.
Okay, so let's dig into the numbers first. The Q2 and H1 FY26 results. We need to get beyond just listing figures and understand the core financial story here.
Right. The headline figures, they really confirm two things: explosive scale and pretty sharp operational efficiency.
Let's start with scale then.
Okay, scale. Q2 order inflow was 1,158 billion.
Billion with a B.
Yeah, that's a 45% jump compared to the same quarter last year. And for the first half of the fiscal year, H1, they pulled in 2,102 billion in orders.
And what's driving that?
It's strong growth, both here in India and internationally, but the really big kickers were these ultra-mega hydrocarbon orders from the Middle East.
Right. And that kind of momentum, it must give them incredible visibility for the future, right? That order book number you mentioned?
Absolutely.
Yeah.
The consolidated order book, the total work they have confirmed but not yet completed, is now 6.67 trillion.
Trillion. That's up 31% year on year.
Yeah, a huge backlog. And what's really interesting is the geographical split. Almost half of that massive order book, 49% to be precise, is now international orders.
So nearly half their future work is outside India.
That tells you a lot about their strategy, doesn't it? They are actively, aggressively seeking those international projects. It helps diversify their revenue, smooth out domestic cycles.
Makes sense.
And the pipeline of potential orders, the prospects they're tracking, looks strong too. It stands at roughly 10.4 trillion, which is up about 29% from last year. So the momentum looks set to continue.
Okay, so scale is huge. What about the other side you mentioned, profitability and efficiency?
Right, because scale is great, but you need to make money. H1 revenue grew 13%, hitting 1,317 billion.
Okay.
And importantly, the profit after tax, the bottom line, grew faster at 22%, reaching 75 billion for the half year.
So margins are generally holding up or improving despite the rapid growth.
It seems so, and the efficiency metrics back that up. These are key to funding that strategic shift we talked about. Two numbers really stand out.
Go on.
First, return on equity on a trailing 12-month basis improved to 17.2%. That's up 110 basis points, 1.1% year on year.
Getting healthy.
Very healthy. And maybe even more telling is the net working capital to revenue ratio. That dropped to just 10.2%.
Lower is better there, right? Means they're not tying up too much cash.
Exactly. It's down 200 basis points or 2% year on year. It suggests they're managing projects efficiently, getting paid faster, running leaner, and that frees up capital, which, as we'll see, they definitely need for their big strategic bets.
Okay, so the financial foundation looks solid, huge backlog, decent profits, getting leaner. Let's move on to where they're placing those big bets. Segment 2, this major global push into clean energy and infrastructure.
Yeah, this is clearly a huge focus area. They seem determined to position themselves as a key player in the whole global energy transition.
And the big news here was that European offshore wind win, right? End of October.
That's the one, a landmark announcement. L&T secured a really critical role in TenneT's big, high-voltage direct current HVDC offshore wind program. This is in the North Sea, covering both the German and Dutch sectors.
And they're partnering with Hitachi Energy on this.
Yes, delivering these complex, state-of-the-art HVDC converter stations. It's a massive validation of their engineering capabilities on a global stage.
Shows they can handle these multidisciplinary, complex projects and leverage their own facilities, too.
Absolutely. They highlighted their 3 world-class modular fabrication facilities as key enablers for this kind of work. It's a big statement about their offshore wind business ambitions.
And this isn't just happening in Europe, right? They're active in the Middle East, too, on the green front.
Correct. They signed an MOU, a Memorandum of Understanding, with Aqua Power.
Okay.
That's focused on the renewables and grid parts of the Yanbu Green Ammonia project over in Saudi Arabia. We're talking solar PV, wind power, and battery energy storage systems, BEPS.
So major green infrastructure projects abroad, are they doing similar things domestically?
Yes, but often with an international angle as well. For instance, they have a joint development agreement with Itosu Corporation, a Japanese company,
What's that for?
to develop a 300 KTPA kilotons per annum green ammonia project at Kandla in Gujarat.
Okay, producing green ammonia here.
Right. But the strategic part is the offtake agreement. The ammonia produced is specifically targeted for ship bunkering, basically fuel for ships, in Singapore.
Interesting. So even the domestic project has an international market focus. It really underlines that global clean energy strategy.
It's aggressive, and it's clearly internationally focused. It's not just about building solar farms in India anymore.
Okay, this makes the next part even more interesting. Segment 3. The parallel push into high-tech manufacturing, especially defense, alongside these big strategic exits. Let's start with that defense partnership announced October 31st. General Atomics, GAASI. That feels, well, game-changing.
It really does. It seems like a profound step towards becoming a high-tech platform integrator, not just a component supplier.
And this is for
manufacturing medium-altitude, long-endurance, male, remotely piloted aircraft systems. Drones, basically. Specifically, the combat-proven MQ series platforms, right here in India.
And L&T's role here is significant, isn't it? They're not just a local partner.
No, they are positioned as the prime bidder for the Indian Ministry of Defense's upcoming program for 87 of these male RPA systems. GASI is the technology partner, and the deal includes critical technology transfers.
So this could dramatically accelerate L&T's presence in high-end defense tech.
Absolutely, and they're building the foundation for this kind of deep tech shift elsewhere, too. Well, they recently acquired power module design assets, R&D gear, patents, IPs from Fujitsu General Electronics in Japan.
Okay, boosting their electronics capability.
Exactly. And they've also signed an MU with the Indian Institute of Science, IIS Bangalore.
A top research institute.
Right. To jointly develop something called a National 2D Innovation Hub. The focus is on next-generation semiconductor innovation, looking beyond current silicon chip technologies. They're clearly investing heavily in the tech of tomorrow.
Which brings us logically to the other side of the coin. Making space, freeing up capital by getting rid of older, maybe riskier assets. The strategic subtraction, if you will.
And the prime example, the one that made headlines, is definitely the Hyderabad Metro concession.
Yeah, talk us through that. What's the plan?
Well, the company announced they've reached an in-principle understanding with the government of Telangana. The goal is to divest, to sell off L&T's entire equity stake in the subsidiary that runs the Hyderabad Metro, L&T MRHL.
And this fits their broader strategy.
Perfectly. It aligns directly with their stated Lakshya 2026 goal, which explicitly includes exiting the public concessions portfolio, these large, long-term public infrastructure projects.
Sounds strategically sensible. But the numbers involved here are pretty stark, aren't they? What was the investment versus the expected sale price?
Yeah, this is where the pain comes in. L&T's total investment in the Hyderabad Metro project was about $70 billion over the years.
Okay, a substantial amount.
Huge. But the sale consideration, what they expect to get back in cash, is estimated to be only around $20 billion.
$70 billion in, $20 billion out, that's a massive gap.
It is. And that gap, that recognition of the lost value is
Right.
why L&T had to take a very large impairment charge in their Q2 results.
How large?
$54.13 billion, taken against their standalone results.
Wait, a 54 billion rupee write-off? That's truly enormous. Can you explain for listeners, what does an impairment charge like that actually mean in practical terms?
Sure. It essentially means the company is officially acknowledging on its books that the asset the Hyderabad Metro project in this case, is no longer worth the amount of capital they've sunk into it. Its carrying value was much higher than its realizable value, the $20 billion they hope to get.
So they're basically cleaning the slate, taking the hit now.
Exactly. It's a painful accounting move, but it's strategically necessary. Public concessions like metro systems, while vital infrastructure, often come with, well, very long and sometimes uncertain payback periods, regulatory complexities, political risks.
Things outside the company's direct control.
Precisely. So L&T is swallowing this massive loss now to effectively wipe the slate clean, remove that asset and its associated debt and risk from their books, and crucially, free up management attention and future capital for those high-tech defense and global energy plays we just talked about. It's a costly but decisive step.
That strategic cleanup, that discipline, must surely impact how they manage their ongoing core businesses too. Which takes us neatly into segment 4. The segmental deep dive and those margin nuances you mentioned earlier.
Absolutely. You can see the effects trickling down. Let's start with the big one, infrastructure projects. This is still the backbone of L&T.
How did that perform?
Well, revenue actually saw a marginal decline, just 1% in Q2. Management pointed to the extended monsoon season, which does slow construction.
Okay, weather happens.
True. But they also highlighted a more strategic factor, a deliberate slowdown in execution on some rural water supply projects.
Why slow down projects you've already won? Especially if the order book is strong. I think you mentioned they have around $400 billion in water project orders.
They do. But it comes back to that discipline, that risk management learned, perhaps, from experiences like the Metro. They're facing sector-specific payment challenges in some of these water projects.
So it's about getting paid on time.
Exactly. Management basically confirmed they're slowing down the work precisely to avoid building assets, spending money, without the certainty of getting paid promptly. It's about capital discipline.
That makes sense. Does this explain why their new domestic orders seem weighted towards the private sector?
Very likely. They mentioned that the private sector accounted for nearly 60% of their domestic order inflows in Q2.
What kind of private sector projects?
Things like residential and commercial buildings, data centers, factories for solar PV manufacturing, even semiconductor fab facilities. Projects where maybe payment schedules are perceived as more reliable or contractual terms are tighter. They seem to be actively shifting their client mix domestically towards more predictable payers.
That's a really fundamental shift in managing domestic risk. Okay, what about the energy project segment? This is where those huge international orders landed, right?
Correct. The Q2 order inflow here was spectacular, more than doubling year on year, almost entirely driven by those Middle East hydrocarbon mega deals. 98% international orders in Q2 for this segment.
So orders are booming, but you mentioned margin pressure here. If they're winning these giant deals, why are margins shrinking?
Yeah, this is the critical point of tension right now. Despite the fantastic order wins, the segment's EBITDA margin actually declined quite significantly in Q2. It fell to 7.3%, down from 8.9% in the same quarter last year.
Why the drop? Are they bidding too low to win the work, or is it something else?
It seems to be mostly legacy issues working their way through. The company explicitly attributed the decline to cost overruns on certain older projects, both domestic and international, that were priced very competitively years ago and are now nearing completion.
So old problems hitting the current bottom line.
Exactly. And management was quite clear. They expect these soft margins in the energy segment to persist in the near term. So the full financial benefit of the newer, presumably better margin international backlog won't really kick in until these older, lower margin contracts are fully closed out and off the books. It's a bit of a waiting game there.
Okay, so a temporary margin headache in energy. What about the other segments? High-tech and the realty development part.
Those look brighter. High-tech manufacturing had strong revenue growth, up 33% in Q2. And importantly, its EBITDA margin improved nicely to 14.7%. This was despite lower order inflows in the quarter, which they said was due to some deferrals.
And the other segment, including realty.
That saw a big margin spike. The development projects segment itself, primarily the Hyderabad Metro before the divestment decision, actually saw revenue grow 10% in Q2, driven by higher average fares per passenger, up from 38 euros of 46 per day.
Okay, some operational improvement there.
Yes. But the big story in the others segment margin, which jumped to 31.3% from 25.1%, was primarily driven by the realty business, successfully selling off commercial space.
So monetizing assets profitably.
Exactly. It shows that even their non-core assets, like the real estate holdings, can still generate good returns when they strategically decide to sell. They still have a realty order book representing flats sold but not yet handed over of about 120 billion.
Okay, so summing this all up, we see this incredible picture of historic order book strength, heavily fueled by international markets and these big strategic pivots into tech and clean energy.
Right, but counterbalanced by these very calculated, sometimes painful, large-scale exits from legacy domestic assets like the metro, and also this near-term margin pressure, particularly in the traditional energy segment as older projects wrap up.
If you connect all these dots, what's the overarching narrative that emerges?
I think the narrative is one of deliberate transformation. The entire strategy seems geared towards maximizing exposure to high-tech, global opportunities to defense, semiconductors, offshore wind, green ammonia, while ruthlessly minimizing exposure to domestic project risks where capital can get locked up for long periods or where payment certainty is less assured.
And a key enabler for this rapid shift seems to be their reliance on strategic partnerships, doesn't it?
Absolutely crucial. You see it across the board. The collaboration with GAASI in defense, teaming up with Tenet and Hitachi Energy for that huge European clean energy project, partnering with Itosu for green ammonia. These alliances are acting as essential accelerators, allowing L&T to quickly scale up and integrate into these new, complex global value chains. They're transforming into a global technology integrator, and partnerships are key to that speed.
It definitely paints a picture of a company in decisive transition, which leads to a final thought, perhaps for you, the listener.
Yeah, consider this juxtaposition. L&T has just booked a staggering, what was it, 54 billion loss, primarily to exit a high-profile domestic concession like the Hyderabad Metro, a project tangled in long-term debt and potential uncertainty.
A very public shedding of that kind of risk.
Exactly. So the provocative question is this transaction, this painful but decisive move, the definitive signal? Is it confirmation that this Indian engineering giant is now fundamentally prioritizing technology-intensive, potentially higher-margin, long-term global growth over the traditional, perhaps riskier, domestic infrastructure contracts that defined its past?
A powerful question indeed, something to definitely chew on as we watch L&T navigate this complex but fascinating transition. Thank you for joining us on this deep dive.